Hello, folks. Brandon Chapman with you today. It's another video for TheoTrade. It is August 26th, 2024. We're heading into the end of summer. It's Labor Day. And of course, as we enter this season, we have Jackson Hole, we have the Fed Chairman Powell talking about policy. Now, it's very frequent that we see that Fed chairmen talk about policy during Jackson Hole. There's not a meeting in August. There's one coming up in September. And so the idea here is that, look, I mean, Powell said something very significant. They are poised to cut rates starting in September. And I thought it was very interesting as he was doing his discussion, conference, whatever, speech. He's talking about the fact that they got inflation wrong back in 2021. That yes, we spent a lot of money. Yeah, we bought a lot of stuff at the Fed. We flooded the market liquidity. But we thought that inflation was transitory, and they found out that that was wrong. And so as we move forward, and now we're in 2024, and the Fed's talking about not raising rates, but cutting rates in response to maybe recent, job weakness or other factors out there, it seems like Chairman Powell he has inflation firmly under control now. We trust us this time. We've got it right. And yet at the same time, they can't even acknowledge significant potential weakness. When was the last time the Fed even called a recession before it happened, right? Never. What has the Fed ever tackled inflation to the extent that, that they've been able to cut rates successfully without either a significant economic downturn or even a short-term transitory sharp rise in prices, like, for example, in the price of oil? The fact of the matter is the Fed has consistently got it wrong on this one, and they've never been ahead of the curve. They've always been very reactionary and have been historically behind the curve. The reality is their interests are not with Main Street, but with Wall Street. They want to allow banks to make money again. They want to allow them to, improve their net interest income, their net interest margin by lowering short-term rates and allowing long-term rates to fluctuate. Higher, maybe long-term rates drop in response to a drop of short-term rates. But the fact of the matter is, if we look at short-term treasury yields, $IRX CGI, this is a 3-month T-bill. Let's try this again. You see we're angling towards 5%. Of course, this will move lower as the Fed begins to cut rates. And right now, effectively, we've priced in a 1/4 point cut already before this September's meeting. You can see some of the volatility here in the interest rate markets. If we look at TNX, CGI, we're looking at what? The 10-year treasury is about 3.8%. Basically, if the Fed begins to cut 1.25%, we'll see it trade below the 10-year treasury yield. The 10 and 2 has already flipped the script in terms of yield. And the reality is, anytime the Fed cuts rates as a means to steepen the curve, it's generally happened at the same time we're entering recession. So remember that, look, I mean, anything the Fed does is very self-serving. Anything the Fed does not necessarily produce the stated results that they are articulating. In this case, saying, hey, we've got it handled on inflation. And how do we know that? Well, let's look at today. So we're going to take a look at /CL. This is the price of oil futures. To oil up 3% today. On Friday, oil was up significantly. You'll notice that it did not open up. And so I guess we should probably look at USO in that case, but let's look at a 5-day, 5-minute chart. You notice Friday, we're kind of gliding along. And then all of a sudden we get here about 1:30 my time, start to see a surge in oil, right? Into the close. And then we see what? We see another kind of move here and a big breakout right around the, this morning about 4:10 my time, AM my time. Point being is that oil's been on a tear over the last couple of trading sessions. This is one of the things I talked about during our Theo live session. We broadcast on YouTube and other avenues live. We have a WisePub page as well. And again, you can join us. But the point being is that we talked about on Friday why oil is in a great position, being very low in terms of supply. The SPR needs to be refilled. We have geopolitical concerns going on in the Middle East. All this stuff coming together, and Powell says he's got this, right? He's got his hands and fingers in the dike trying to stop this wave of inflation. He's got control. He's assured us that we're going to get to the 2% which, by the way, is still a confiscatory level of inflation. By the way, nobody wants 2% inflation unless you benefit from it, right? But the idea that oil price is breaking out today. We look at the rest of the commodity complex, right? Gold's up 1/3% or 0.3% today. Silver is up 0.44% today. If we look at copper, up 0.2% today. I'll just bring up the ag ETF DBA. Ag commodities up 1.18% today. Great. Food prices going higher. Oil prices going higher. Prices of other commodities, industrial or metals, like, for example, gold, everything rising in the commodity complex. We look at DBC, up 1% today, kind of factoring in the breadth of commodities. A little more of a focus on energy, but okay, we're up 1% today. That's great. So costs are up 1%. Stuff we buy, the S&P is down 0.25%. Wait, what happened to the wealth effect of the markets? Here's the deal, folks. Energy is up nearly 1% today. Staples up 0.7%. Utilities up 0.65%. This is not a story that is bullish for the market, okay? In fact, if we look at this, the S&P compared to the 11 S&P 500 sectors is the third worst performing today. XLK sold down 1.25%. XLY cyclicals. These are the two high beta parts of the market we talked about last week. And today, post Jackson Hole, we're saying what? These are sold, and defensive parts of the market like utilities and staples are bought. And also metals, XLB, and we've got energy in there as well. So the point being is this is not the tale that we should tell of economic strength and a very calm waters of inflation. This is much more to do with the fact of risks to the upside in the inputs that we use on a daily basis that could propel inflation higher. We've seen this before, right? In fact, let's bring it /CL. Let's go back in the Wayback Machine. We'll go back to, let's say, 20 years here. I don't know, can even bring in 2008 in 20 years? Yes, we can, I guess. But notice what happened back here in 2007. The Fed began to cut rates. What happened? Oil prices began to spike until they eventually reached a climax in July of 2008. Oil prices went from about $43 to $50 up to about $150, basically nearly tripling in price. The fact of the matter is, oftentimes at this stage, as the Fed is trying to normalize the Treasury curve by driving down short-term rates, they get it wrong almost every single time. The risks in prices and inflation are to the upside. The 2% is not likely to be achieved. Well, you can say, yes, but they achieved their policy. I get it. Yes, oil prices went to 146 down to 33. Yes, they solved the problem of inflation because their monetary experiment blew up in their face. It's called the Great Financial Crisis. Okay? I'm not rooting for, I do not want to see a great financial crisis. Nobody wants a financial crisis or an economic crisis. But the fact of the matter is their policies have not only yielded much higher rates of inflation than they expected. Not only did they get it wrong on the transitory side, they're likely to get it wrong on the economic side. And frequently, it is the rise in commodity prices that finally pricks the bubble and causes us to collapse. And so again, as we look forward right now, yes, the Fed may be on pace to cut rates by 1% by next year or more. The fact we're projecting that at this point in time suggests things are materially weak. And last week's jobs numbers, the revisions, certainly show that it's likely we're already in recession. And so what is the Fed really doing? Are they cutting rates because inflation's under control? Or are they really cutting rates because we're on the verge of a cliff and we're about to drive off it? I'm sorry, Thelma, Louise, Powell, and Yellen, we can combine whoever we want. They're driving us off the cliff economically through just poor monetary policy. But the reality is, what is the Fed really going to do? Right? I mean, the Fed is 12 voting members making policy for an entire country, if not a world. The fact of the matter is they are going to get it wrong. Moneyed interests are going to play a much bigger factor than Main Street. And we are going to all participate both in the inflation and the after effect of inflation. But right now, as we look at oil prices, as we look at CL going back to this daily chart, not only do we have the inflationary headwinds created by the Fed looking to cut rates, we also have very significant supply issues. This is reflected in the product depth graph, right? So let's go to /CL. We'll look at futures here and notice where we're at. Okay, this line is from 8.5. Notice the trajectory. Notice the trend or the slope here of this line is going down. And by the way, rather sharply too. But the idea is this is slope downward. Why? If you look at supplies, we're near the 5-year low with a very drawn down SPR, which the federal government has sought to add a little bit, chip in some barrels of oil to help refill it. But again, we're talking about what? The fact is that we can, to be able to secure, finance the oil, to store it, and then the lease rate, it's called the net cost of carry, is positive, meaning that we're driving down price out here. This is not meaning that oil prices are going to fall. This means that these prices back here are going to converge with the spot. It's going to tell you that the risk in oil is to the upside. And the last 2 days, we're finally receiving that benefit. And you'll see some big moves, right? Even a couple of weeks ago, the end of July, start of August, we saw the run here. We saw it back here. We've been able to see the oil price stall out as we get towards 85, 86, recently at 80. Is this the one that finally breaks out of a bigger pattern here? Let's bust this out to not go 3 year. Let's go 10 year. Notice where we're at right now. We'll draw the Fibonacci retracement over that very low price in 2020 up to the highs. We're kind of floating along this 50% retracement. We look at the winnowing in of price, this convergence here in prices over the last while. We are certainly on the verge right now of a significant breakout in oil. And what the product depth curve tells us is the expectation is the breakouts to the upside. What if oil prices get back to 120? Well, let's look at the range here. The range is from 63 to 95. We'll just say 30 points. Off of a breakout of 83, add 30 points to that, we're talking what, 115? Okay. If we break out the top side of this symmetrical triangle, oil prices could really accelerate. And we know that oil prices can really run and then sell off on economic weakness. But right now, prices are likely going to adjust to force us to what? Use less oil. Maybe that's what they want. But the reality is, again, I use this term reality a lot today for some reason. Probably should back off it. Excessive use of reality. But the problem is that we may very likely have a big move higher here in oil because the Fed is about to cut rates. And well, who knows at what rate they're going to cut rates, how quickly they're going to get to 3.75% to 4% or 4 to 4.25%, how quickly they're going to get there, how quickly the economy may start to tumble. I was reading today about, what are they? Motorhomes. Nobody's buying motorhomes, right? So we're looking at this, and again, luxury spending, discretionary spending. Again, we've seen so far that services are kind of holding up okay. We're on a very, very, difficult point right now where you're trying to read, are we in recession or not? It's not like, when is the recession going to occur? It's more like, hey, are we there yet? Or are we just about to see us roll into a town on empty, looking to refill the tank with Fed liquidity and interest rate cuts? So we see the move in gold today, right? So it's not super big, but notice what happened. Gold is already broken out. So if we back this out to like a 1-year daily chart, we had this kind of consolidation phase going on. We broke out, we kind of fell back in again, then broke out again, formed a higher low, and we're edging higher right now at 25.54. Let's gain a little perspective on where we currently stand. This is the highest oil prices have ever been. Gold prices have ever been. This tells you something. This is the weakest the dollar has ever been. This month is the weakest the dollar has ever been. The purchasing power of your money is the weakest it's ever been. Is that going to continue as the Fed cuts rates, as inflation is still a concern and growth is a problem, right? That's what we describe as stagflation, and that's precisely a position that gold loves to be in. So if we start to see falling long-term rates, falling yields in the bond market, that benefits gold. If we see the Fed start to pump money out there, that benefits gold, right? It devalues our currency. And if the economy remains weak, guess what? Gold performs well. So I'm expecting gold to continue to move off of this breakout. So I've, on a weekly basis, continue to kind of push gold as a strong area of the market to outperform the S&P 500, which it's done for a while. But again, also oil, because of the backwardation, and maybe, just maybe, we're on the cusp of a breakout here. So again, how do you hedge prices at the pump? Maybe you go long oil as a hedge against your pump prices. But the issue is gold is potentially set to see a major breakout here if we start to clear this 84, 85 area. The secondary effect today, we look at staples and utilities. Notice how staples performing here, right? Staples never sold off during that sell-off in the market on August 5th. Yeah, we were down a little bit here, but we recouped quickly. Utilities. Yeah, we had a stumbled on the 5th and gave up 2 days of appreciation, and we're off to the races. And today, we closed at a new 52-week high, if not all-time high in utilities. We saw earlier, if we look at, for example, SPY plus XLU, I look at a rate of change, and unfortunately in Thinkorswim, you cannot apply rate of change. You got to use a pairs ratio, and you look at this on a weekly basis. Notice what happened here. And again, this broke back here on the 15th of July. We saw on a 4-week rate of change basis, it said to sell the S&P and buy XLU, and we're still under that regime today. It also happened back here on March 4th, right there. Sell S&P and buy utilities. Buy S&P, sell utilities on June 3rd. Sell on July 15th. Sell S&P, buy utilities. This is a binary strategy. Either own SPY, XLU. We've been since July 15th under the regime of own XLU, sell S&P 500, and that's generally done fairly well since the 15th as utility prices have been higher and the S&P has had to round trip off of its sell-off just to get back to the same level it was that week of July 15th. So this is not a strong posture based on today. And I think dovetailing with Powell's statement on Friday, I think the script has flipped for the commodity market and for just general strength in the market. Today, long puts being traded in Citigroup and CLH. We saw bullish trades in Hecla. Saw bullish trades in Cleveland Cliffs, CLF today. Long call activity. This is part of that commodity space. And yes, it was a nice breakout of 3.84%. One in the past we've looked at if the dollar's weak. You can look at Vale, assuming Brazil remains relatively strong. Again, this is a producer of iron ore. But again, we've talked about FCX for the last number of weeks here. And again, we saw last week a couple of big option trades in FCX. It was up 1.19% today. Benefits from gold and copper. So you can kind of look at the metal space as well as what metals producers, precious metals in particular, Hecla, at resistance at 6.25. If we break this, there could be significant upside here if we start to break out maybe to 750 and beyond. Let's go back 20-year monthly. Again, we may get up towards 12, double in price, potential double if the sell-off in the dollar responding to Fed policy really plays out as potentially bearishly as it has in the past when the Fed starts to cut rates and inflation monster is not slain. So let's look at that. Other producers, PG today, a long call activity in PG, consolidating up against resistance. This is the second time we've seen some big op call activity in PG. And if we look at Coke, Coke broke out today. We're going towards more of those defensive-oriented stocks and sectors. That's the second best performing sector today. And again, we got utilities on the mix today. May as well just look at XLU. But the idea is there may continue to be upside here. But if the market breaks, these will break with the market. But as long as the market remains weak and we're not seeing a sell-off, we'll probably see continued rotation to these types of sectors here. I'm expecting financials likely to fall off here from this current level. It's very extended. Again, Fed cuts do help financials, but I think we've probably likely priced that in to a large degree. But the big news this week is going to be NVIDIA. Does NVIDIA disappoint? Today it did 2.25%. Wednesday, we'll probably doing a special session on Wednesday of Theo Live at the close this time, but we'll be kind of looking at the results of NVIDIA's earnings. So look forward to that. But again, Wednesday after the close could be a big, make sure it's Wednesday. Today's the 26th. Yeah, Wednesday the 28th after the close. We'll be looking at that and seeing the impact, because this could be huge. If all of a sudden they downgrade some of their expectations, we got the run up here because they kind of restored faith in those estimates. But if we start to cut guidance, of course, the CEO has been selling stock like crazy over the last couple of months. We'll see if his timing is good and the correction in NVIDIA is about to take place. Or does NVIDIA break out? We see a rotation back towards these stocks. I just don't see that we have a lot of upside here if the news is good versus the downside if the news misses expectations. Well, folks, that's the video for today. We'll catch you back next week.